Let's start with this equity market rally that we're seeing. Do you think it has legs, Mark, or do you think that yield story is a potential headwind?
I think it absolutely has legs. I think we're still in the Goldilocks scenario that we've been in since the Fed meeting in December. And that won't change until we get enough data prints to either kind of say, hey, wait a sec, we're getting rate hikes, not just fewer rate cuts, we're getting rate hikes again, or unless the data is bad enough to suddenly say, hey, we've got a recession out there. Ultimately, yes, higher yields is problematic for equities in the short term. Every time we get a yield spike, equities sell off. But ultimately, an economy that is strong and can cope with higher yields is a good story for equity markets. So until we get those sequence of data prints to change, and that won't happen overnight, it requires a sequence of data prints, well then the story is that equities will keep on climbing that wall of worry. It won't be a sudden gain, but they'll keep on climbing that wall of worry despite higher yields.
And Asian markets right now up 0.8%. But then you look at China, mainland China and Hong Kong, and once again, it's a brutal day, Mark. What do you make of what's coming through? We're getting stories around mutual fund liquidations hitting a 5-year high. We've had Citi saying that their bankers on the mainland shouldn't talk about the yuan. Are we seeing panic now setting into these Chinese markets?
Absolutely. I'd say it's another round of panic. I think this is the most extreme I've seen for some while, which maybe, as you know, my colleague Mark Cranfield put it this week, might be a kind of a sign of a capitulation. Not necessarily the final capitulation, depends which way you want on this, but yeah, certainly we're seeing some quite extreme kind of comments out there. And, you know, that story that passive funds, mutual funds are kind of winding up, that's kind of showing that liquidation that's happening in the equity space. We've seen an article out from Paul Krugman from the New York Times overnight saying China's economy is in big trouble, which we've kind of known for some time. I think there's a clear narrative to attack China out there, and it's an easy target on the economy because the economy's been struggling for so long and the markets are really struggling. So if this is a capitulation point, it might only be a short-term one, but it does feel like sentiment-wise we're in that kind of, I'm not saying today, I'm saying over this week, next week, maybe this month, we're at some kind of at least short-term capitulation point in that sentiment in China.
And Mark, you touched on the yen, and we're seeing that softness, as you said, down 0.2%. The inflation coming in slightly lower than maybe some had expected. Is the BOJ meeting, do you think, Mark, next week, is it still live?
It's going to be really interesting because I suspect that they're going to probably make some kind of statement which is guiding towards possible tightening, exiting from negative policy. It's going to get people excited and might cause some short-term volatility. It might get a short-term kind of squeeze higher in yen. Ultimately, though, the BOJ will disappoint. It'll disappoint and confuse because that's what they've been doing for a long time, and that's what they're very, very good at. And I suspect that even if they provide some kind of guidance or encouragement towards policy tightening at some point this year, they'll probably undermine that later by kind of suggesting they're not sure if inflation is sustainable. So short term, we might get a little bit of a yen bounce, but within a couple of weeks after the meeting, the yen will be weaker again because it has deeply negative real yields.